Siddharth Purohit, Senior Equity Research Analyst Banking at Angel Broking, is now joining us. Siddharth, first, Yes Bank, the fundraising that they have done, would it incrementally be positive or it's already in the price?
Pankaj. See, the private banks, as you know, have been growing pretty fast their balance sheet, and for that they really need capital. And accordingly, I think a lot of other private banks, including Yes Bank, were looking for raising money at the right time. And I think these all should add to that growth momentum for this set of banks. And if you just go by the last couple of quarters number, it has been observed that most of the private banks have really exceeded the industry growth rate, and to continue that momentum, certainly capital is required. And in case of let's say Yes Bank particularly, I would say that their tier 1 capital was little lower than what that should have been. So just to meet that requirement, possibly raising capital was a good options for them. Right.
What is the sort of decline in credit cost that you expect because of this, or the cost of funding which can come down?
So you can't say just because of this, but there is a trend of declining cost of fund for the industry as a whole. If you just observe the GSEC yield, it has really come down in almost a 15-17 basis point in last 1 month itself, and that is impacting the kind of fundraising at incremental cost of fund for all financial services company, including banks. Now, what one part one should see is that while the GSEC yield has gone down, but simultaneously the deposit rates of most of the banks has yet to come down, and that should start coming down in a couple of quarters, and that would possibly help most of the banks reducing their cost of fund. But only as of now, only the cost of borrowing has come down. The deposit part is really yet to get repriced in a big way, and that should follow in say a couple of quarters down the line.
Generally, dilution is not seen as positive for any equity. But if you look at right from the last 5-7 years, whenever there has been a dilution in a bank or a good NBFC, the returns from there have been particularly good. Why is that so? Can you explain that for us?
See, one part is that, if a bank is able to deploy its capital, raised capital in a proper manner, and able to generate similar ROE, or at least, maybe higher ROE than what they had been delivering previously, then there is no harm in raising capital. And if proper allocation of capital is done, and the NIMs as well as your return ratios are maintained, then there is nothing negative for the minority shareholders. And anyway, capital is the input for all the BFSI space, particularly banks. So as long as you are not well capitalized, you cannot grow. So what I see is that a bank which is able to generate or maybe raise capital at a decent valuation would be considered will be taken in a positive way because of its ability to deploy capital in a proper way and generate profit out of that. So I'll not say that always there is a correlation to it, but normally it happens that a bank normally raises capital when there is visibility of higher earnings growth coming in the coming couple of quarters or years. And any bank will not really like to dilute without being able to deploy that capital. So any bank which has really been able to generate at least similar ROE what they had been able to deliver earlier, then in that case I'll feel that that possibly dilution is a rather positive way, and dilution is a regular phase of part of business for any banks, because capital is the raw material for any banks, and that is what they need to deploy and generate profit. So I'll not generalize it.
What happens to the price to book value, the technical adjustment? So a Yes Bank would be raising funds at about 3.5 times price to book value. That itself will raise the book value per share, and then the stock starts to look cheap?
See, anyway, when you dilute it, possibly, I cannot tell you exactly the valuations post this dilution, because I have not considered that as that part. But what I can tell you is that, anyway, if the money is being raised at the current valuation, so market has already factored in. And now what market is sensing is that if this money is getting deployed and able to generate substantially decent ROE, what the bank had been doing earlier, then there is no reason why your price to book value multiple will go down. Possibly it will stabilize it, and further re-rating in terms of price to book value will happen only if the bank is able to improve the return ratios here onwards. But price to book value multiple is a function of pure earnings growth. While your absolute book value change because of the dilution, the multiple doesn't change. The multiple should change only because of your earnings only.
What would you make of the recent surge that we have seen in the PSU banking space? Is it only because of the yields coming down?
See, if you observe the earnings quality of Q1 results for the PSU banks, one can observe that there was a substantial reduction in the loss that has been reported by PSU banks. That was one part. Second part, the quantum of NPA that we saw initially has also tapered down. So absolute amount of NPA formation also came down. Now, subsequently, what has happened is that the government has also announced that they intend to fund more for cleaning up the balance sheet. Now, third thing is that the consolidation within the industry. Now, post SBI, announcing their merger of other things, other associate banks, there has been a hope that there will be a consolidation within the PSU banks, and there would be a set of larger and stronger PSU banks. Now, these are the fundamental things changing on one side. But if you talk about core growth, that is the business growth. If you just look at the latest RBI data, the business growth is really not really indicating substantial pickup. The latest data shows that that loan growth has been around 9.4% YY. So it is still in single digit. So while the business growth is not picking up, there are other factors that is supporting is a GSEC bond yield. Now what we saw in Q1 is that because of softening GSEC yield, there was a substantial treasury gain for almost all the PSU banks, and that protected them from not reporting a loss despite weak operating parameters. So probably same thing can happen in this quarter also, that the largely bottom line will be supported by your treasury gain for this quarter. And while this will be a one-time gain, but obviously it's an indication that something there is a trend towards lower interest in the economy, and credit growth should start picking up. While we have really not seen large credit uptake as of now, but possibly now that should start happening. So fundamentally, if you speak, the PSU banks' performance are yet to see any improvement, and they will not see major improvement during this quarter also. But there are certain structural shift that is happening, and possibly that's why you are seeing some amount of buying in the PSU bank of late.
What would be your top picks in the PSU banking space?
See, we have been positive on SBI only, and rest of the PSU we are really not very hopeful as far as earnings growth is concerned. First of all, SBI has is in the process of consolidating its associates. Secondly, they are decently capitalized, and on top of it they have announced a significant capital raising program. And if you just observe one thing, that while I'm talking that the industry is growing by 9.4% so far, SBI management has been saying that they will be in a position to grow 12 to 14% loan growth. Now, on other hand, if you see that private banks are growing in excess of 20%. So this is the only bank in PSU space which has really not lost market share compared to the private space. So we still believe that SBI, while the stock price has gone above our target price, we believe that there could be some positive triggers left for in terms of earnings, and that's why we have a positive stand on SBI. For other PSU banks, we are really not very constructive. While one can see that stock moving up, but earnings might disappoint. That's what our take is in the near term. So we are not hopeful of any turnaround in the tier 2 or tier 3 PSU banks for the timing. We'll stick to the large banks to SBI so far in the PSU space.
As far as Bank of Baroda is concerned, what's the view? Considering that last 3 quarters they have continuously written off and always told that they would want to increase their They would largely not want to raise capital as well as look at better profitability. Is the market giving that slightly higher valuation to Bank of Baroda?
See, if you observe Bank of Baroda's commentary in last 2-3 quarters, always there has been a kind of disconnect that they come out with a first view that in Q3 last year that a lot of cleaning has already happened, and possibly thereafter you may not see a lot of stress coming in. But subsequent quarters in Q4 because of AQR and even in Q1 we saw large slippages coming in. So incrementally we may not see a lot of slippages coming in, but given the current valuations, and I believe that Bank of Baroda may not offer you much upside. And look at their balance sheet, that has kind of degrown this quarter. So on one side your balance sheet is not growing. So possibly what is happening is that there is already a pressure on the earnings front because of your interest income not really growing very fast. Secondly, incrementally, while they are saying that your stress large part has been recognized, there are a lot of stress coming in from the not the so large accounts. The mid-size accounts are also falling into NPA. So while I believe that there may not be much of negative, but I don't see much of positive happening in Bank of Baroda's earnings for the next couple of quarters. So we'll not be really very keen of buying Bank of Baroda at this place, but we would rather go for a larger one like SBI, which has more positive left for them. And as far as the performance for next year is concerned, Bank of Baroda, I believe that they have enough capital, but I believe that the management is already kind of of a view that once they should kind of clean up the entire balance sheet, and then they should go for a balance sheet growth. So I believe that for next couple of quarters at least, you may not see any positive things developing from the PSU space, including Bank of Baroda. But of course, that kind of exception to SBI. SBI can positively surprise in coming quarters. Even during this quarter also, the management has highlighted that they might go for a revisioning their credit demand target. So while the industry is not growing, SBI has been able to grow their balance sheet. On the other hand, if you see BOB, their balance sheet is degrowing. So it's a clear call that PSU within the PSU one has to really differentiate between the large PSU, the strong PSU, and the weak one. So in the strong space, we'll put SBI on one hand and the rest of the pack on one hand. So we'll clearly go with SBI rather than other PSU banks for the time being.
Right, Siddharth. Thank you so much for explaining us what's happening with the PSU pack as well as what one should view Yes Bank in terms of their funding.